Good afternoon. We'll get going in about a minute or so and give people some time to keep logging on. All right, we'll go ahead and get started. Thank you everyone for joining our quarterly webinar. I'm Lucy Barbarian. I'm joined today by the members of our investment team. We have John Regan, Alex Goldfarb, Connor Carew, Josh Baxa, and Xander Keogh with us. The markets have been all over the place. We've updated the slides multiple times with all the changes. This all came as we were hosting two large events, the Finance Speaker Series at the Citadel and Vine. With that, I will hand it over to our CIO, John Regan, who's going to speak more about the events and kick us off.
Thanks everybody for joining us today. Like Lucy said, we redid the slides twice, and then again this morning the markets then moved another 3%. So it's been all over the place. We're going to try to, as usual, boil things down to very simple sound tidbits without using jargon. As Lucy said, it came in the middle of a very busy two largest events we've ever hosted for the firm. The Vine conference, which is values-based investment networking exchange. We had an inaugural 3-day conference here in Charleston, which was fantastic for our faith-based clients. And then hot on the heels of that, we hosted Bill Ackman, who came down and spent the day with us last week. And we had a turnout of almost 290 people at the Citadel Business School. Moving on to Josh. So what we're gonna do a little something different. We're gonna replicate what we did at our Vine conference, at our values-based investment networking exchange. We're gonna cover 3 major topics in this webinar. The first is resetting the global table for trade, so I'll cover that. The second is expected rates of return. Connor is going to take you through how endowments and family offices will look at putting a number on what you think an asset is going to make, and then backing into your asset allocation. This is a process that investment committees go through on an annual basis, and they come up. We'll show you the games played and kind of how you wind up with different asset allocations. And then last, beyond stocks and bonds, Alex is going to cover non-stocks and bonds, alternatives, and private investments. So everyone focuses on the first 3 things, which is stock, bonds, and gold. But the investments beyond normal risk assets. Resetting the global table. So let's move along, Josh. We're going to play a video from Scott Bessent. And this is actually from back in June of 2024, before Trump was elected. And he tells you, so this is almost a year ago, he tells you where we're going.
I think we're also at a unique moment geopolitically. And I could see in the next few years that we are going to have some kind of a grand global economic reordering. It was something on the equivalent of a new Bretton Woods, or if you want to go back, like something back to the Steel Agreements or the Treaty of Versailles. There's a very good chance that we are going to have to have that over the next 4 years.
Okay, so that was a year ago when Scott said that, and actually right around that time, we shared a lunch, and we talked about what tariffs were going to be, and what was indicated was a slow reordering, an orderly reordering of tariffs and trade in a way that everybody agrees resets the table to be a little more fair in the United States, because we've taken out too much money on our credit card. And that debt has flowed into consumption outside the US. So that's what Scott said a year ago. And he said, one key thing he did also say was he envisioned that we would ratchet up 2.5% a month on China. And these things would be gradual rather than what we got. And what we got was instead this. We got a tariff card that aligned Algeria with China. And so really what we got here was, okay, here's the drop dead date. Tariffs are going into effect on this date. And everybody, our phone lines are open. Come talk to us. This created chaos, which resulted in the S&P opening, the Dow opening up down 1,500 points. And go back, Scott. Go back, Josh. And so this chaos, really, when we really think about this, is look at the top 15 countries on the left. What we care about is dollars, not percentages. We can't eat percentages. We owe dollars. So the Myanmar trade imbalance with a proposed, 80 or 45% tariff on trade from Myanmar is irrelevant. What really matters is the first 10 or 15 boxes on this chart. And I think the mistake that was made is when you put everybody up on a chart like this, what you're doing is you're uniting Myanmar and China, and you're uniting Myanmar and Algeria against the US. If you have 15 difficult conversations to have, maybe better to have them in private and pit them against one another as opposed to putting everybody up on a poster board. And I don't think this actually was Scott Bessett's idea. They seem to have backed off this, and the minute it was tweeted by both Bill Ackman and other people, a 90-day moratorium, the market went back up. So moving ahead, Josh. So what we've gotten is the difference between Trump 1 and Trump 2 is a 10% decline in the S&P. It sounds a lot worse than it is, but really it just does come down to about 10%. So, if you own a stock for the last 10 years and you have triple-digit gains, and that stock is the S&P 500, you lost 10%. You lost a little bit. What you can see, though, is all of the markets globally traded off on this. And what's happened, interestingly, our non-US managers are vastly outperforming. We have non-US simple EFA managers that are up 13% for the year with the S&P down 10. That's a 23-point swing, whereas last year they were flat with the S&P up 25. So non-US returns have been pretty strong, positive, while the S&P is sold off. Next slide, Jeff. So trade war gives us bad things. Oh, and by the way, the other, Scott Besson talked about the Treaty of Versailles, Bretton Woods, the IMF agreement, the Plaza Accord. The trade accord is going to be called the Mar-a-Lago Accord. The Mar-a-Lago Accord will be the great reordering of trade that will be, quote unquote, a little more fair to the US. But sentiment has never been worse than when you have trade war. The sentiment is actually very similar to 9/11 right now when you see the trade war at the lows. Next slide, John. So the proposed tariffs are, if you see on the right side, we bring us all the way back to around 1938 or 1930, which Smoot-Hawley was a reaction to the stock market crash. And this chart kind of indicates that if you look at the last 20 to 30 years, we've had nothing but trade tariffs coming down, trade barriers coming down. And China has very much taken advantage of that in the last 20 years. That trade imbalance has translated into a run-up on our credit cards. So our debt is now 122% of GDP. We have effectively subsidized, or in the opinion of the Trump administration, we have effectively subsidized consumerism around the world with people producing for the US. And it's resulted in, coupled with massive silly spending in the US, and you wind up with 122% of GDP. Good, Justin. So this is a short note I wrote to one of our clients recently. And I said that, we're kind of, which leads you to China, right? So what we sort of have to do with the tariff card is not unite the world against us, but unite the world to understand that China is playing the trade game against all of us, not just the US. We're the biggest dollar loser, but other countries are having these massive trade imbalances with China, and their fragile economy is really built on this. So I think we're in four tables of poker, simultaneous tables of poker with the Chinese. The first is the tariff table, and we know we're playing that game. I think we're winning. We kind of sort of kicked the ball in our own goal in the first quarter, but we're sort of winning it because if we have a massive trade imbalance with China and we shut off China's ability to ship product here, that hurts their economy with much more immediacy than they can hurt us. So I think we hold reasonably good cards at the tariff table. And what I expressed was a concern that, okay, well then if China's losing at table one, they move to table two. Table two is US Treasuries. Can they mess with their holdings of US Treasuries? Can they mess with our 10-year yield? Can they manipulate things so that we get into a Treasury crisis? That would be bad. And there are indications that they were doing this. They're not the only large holder of Treasuries. The Japanese own big chunks of Treasuries, but we think that they're friendly to us. So we worry about what are the monetary games that could be played that are part of economic warfare. Chinese are probably playing at that table right now. And then I worry that if you lose at the first two tables, you shift to the third table. The third table is gray war, which is actually bottom right. They probably should be reversed. Gray war is cyber, messing with the power grid, hacking, shutting down corporate entities, like we saw what happened to the movie studio out in California. Gray war is messing with your economy or messing with your country in a way that ratchets up the pressure, but is not kinetic. And I say kinetic, I stole that term from Admiral Stavridis, who was the former dean of the Fletcher School at Tufts. And kinetic is when you actually start shooting at each other. So if the Chinese really are losing and they're really fall into a panic where Xi believes that he is losing control of his Politburo, that's a great time for a distraction in the Taiwan Straits, which is exactly what happened with Ukraine. So I worry about these four simultaneous tables of poker going on. And if we're going to win at the first two, does it then shift to the second two? And I think this is kind of the game that's going on with China right now. And I think the goal here is to stay at table one, not to move to the other three tables. Move ahead, Josh. So let's talk about three concentrations that keep you up at night. The first is top 5 market concentration. We have used this slide multiple times, but if you go back to 1964, you kind of had the Nifty 50 back then with AT&T, GM, Exxon, IBM, and Texaco. In 1999, when I was a young budding analyst, the top 5 concentration was about 14% with Microsoft, Cisco, but tech at this time period was about 30% of the S&P, or maybe high 20s. The peak levels of concentration that we have now, we have top 5 up around 25%. And those top 5 are Apple, Microsoft, NVIDIA, Amazon, and Meta. You could probably throw in the other 2 from the Mag 7, and that gets you to an even greater level of concentration in the mid-30s. So that first risk is stock concentration in the U.S. market. Does the U.S. market matter that much? Well, it does, because then it creates a sector concentration. We're extremely levered to tech. Tech has done awful, which is why non-U.S. markets have looked better, because tech is generally in the U.S. So that's sector concentration. But does it matter to the rest of the world? Next slide, John. The rest of the world, so if you think about the concentration in the Mag 7, the concentration in tech, which then concentrates into the U.S. as 65% of the market cap of the world, with 1/3 of the 65 being in 7 stocks. So this is going from stock to sector to world concentration. This world concentration has now permeated out, and everybody is realizing, wow, we have way too much stuff in the U.S., and you're seeing a flow of funds out of the U.S. People are selling bonds. The Chinese are selling treasuries. Other people are selling treasuries, and they're voting out of the U.S. with their feet, which is why non-U.S. managers are up, the U.S. market's down, which is why it's very important to be able to invest outside the U.S. in simple stocks. Skip the next slide, Jeff. This was a great slide that Josh did, and then I realized we color coded it the wrong way. But let's look at the supply demand imbalances. If you want to understand economics, you got to look at oil. Everybody needs to read The Prize, Daniel Yergin. It's only 900 pages. It's a great light summer reading book. But Yergin described basically theory of economics through WTI and oil. This is side by side daily oil consumption versus daily oil production. And let me just point out the imbalances. Generally, oil is about 100 million barrels a day, 198, 101, and generally in balance, supply demand. But look at who's imbalanced. On the bottom, we are the largest consumer of oil at 20 million barrels a day, but we're also balanced with about 20 million barrels a day of production, 22 versus 20, relatively balanced. Look at the imbalance of China. China consumes 15 million barrels a day, second largest world economy, but look at how little they make, only 5 million. So similar to Japan pre-World War II, China really is, as the Treasury Secretary described, a fragile economy. It has a big supply-demand imbalance, and they can't produce enough energy to power their economy. The other big imbalance I point out on here is Russia. Russia consumes only about 3.68. Russia is the pink, but produces about 11. So we have China imbalanced on the supply side. We have Russia imbalanced on the, China's imbalanced on the demand side. Russia's imbalanced on the supply side. So that's a match made in heaven. So that's why one of the reasons those two are going to be united in a house of war against. But that is basically the oil market. And strategically, when you look at these imbalances, plus or minus 500,000 barrels a day on either side will drive the price one way or another. Moving ahead, the retail investors got into the game this quarter. Gold is now through 3,400, record highs. Our clients are happy. They own nice chunks of it. It's insulating the portfolio on the stock side, and we've used it occasionally when we've got big sell-offs to actually as a source of funds. And you'll see retail, since our last call, retail participation by the ETFs has gone down since 2020. It is now reversed, and it is an uptrend. So it was central bank buying before. Now we have retail buying gold. This is a new slide. Skip the next slide. And the return of gold has now far outstripped. It's double that of the S&P since 2000 in the last 25 years, with a lot of that coming just in the last year. So a lot of that big divergence has come, but you are more than double the S&P now in the last 25 years. Watch the 10-year yield. This is a day chart, so this is just March and April, and you can see we had this Treasury crisis moment a couple of weeks ago with a 40 basis point move in a week. So we want to really watch this 10-year, and there's a big Treasury refinancing coming up. So conclusions, the attempted global reordering is messy. It probably didn't need to be this messy. I think the conclusion will be the Mar-a-Lago Accord. And I think in the end, we will need to declare victory. So whether we get what we want or not, we're going to have to declare victory. That is the only thing that makes stocks go up. We need stability. And the last week's comments on Jerome Powell were not helpful either, because it created instability. When comments came out today, saying that there was no reason to think we were going to try to unseat Powell, the market went up. So the markets like tariff delay, they like Jerome Powell in the seat, and they like when Scott Bessent's talking. So those are the three things that have made the markets go up. The market does not like it when we are lobbing big tariff things and creating tariff instability. Second, I think we're headed toward 3 new trading blocks. So a lot of questions. Do you think we're in a negotiation with China or a war? I think we're in a war. I think we've been in a war for 25 years. And trade war and economic war is no different than kinetic war. So I just think about those 4 tables of poker that we said. I think it is a continuum of economic warfare to kinetic warfare. Gold is flashing a warning sign. I mean, I used to say if gold is at 3,000, you'd want to be selling everything else. It's a little concerning. It's a fear factor. People are buying gold because they're afraid of other stuff. Keep an eye on the 10-year. And last, all of our lives get a little better when Trump declares victory. So the trade stuff. Moving on to how do you asset allocate in all of this, and how, with all these big changes, and we've had a couple of huge changes this quarter, how do you look at expected rates of returns and figure out what to buy and what to not buy? And Connor will take you through that whole process.
Thanks, Sean. Thanks everybody for joining. Yeah, if we could go to the next slide to give a preview of the concept here. So we obviously are tasked with managing capital for you across multiple menu items. So what does the menu look like? The left-hand side is everything pretty much available to us at the top level. So in the top left, you have cash and fixed income. In the green, you have equities. In the purple, you have alternatives. And in the dark mustard, you have gold and hard assets. And we build a portfolio based off of these inputs. And you may ask, okay, PermCap team, how do you think about structuring these things? They have different risk profiles and returns. So to keep things simple, we look at the past and then we think about the future. So the past is the left-hand side. The left-hand side is 20-year returns, 10-year returns, 5-year returns of these asset classes. So what are some observations that pop off? Fixed income has not made you any money over 5 years. If you were in traditional fixed income over the last 5 years, you've lost 30 basis points a year. Equities, US equities dominated the world, up about 15% on a 5-year basis, 20%, 10% on a 20-year basis. Venture and private equity have done very well in a low interest rate environment, as you can see in the bottom middle. And gold, despite maybe people not really believing in it and its ability, has surpassed even equities in the near term. And on the right-hand side, we use the sell side estimates to think about, okay, what could returns look like going forward? It's kind of a reversion to the mean is really the work most people do. And so you look at JPMs anticipating fixed income to do better, equities to come down a little bit, and the same is true as alternatives. If you go to the next page, another really interesting observation is two things, and I'm stealing this from John. Big banks will not project negative returns over 10 years. So John will tell you when he was at Cornell and people tried to put different asset classes in the portfolio, everybody had a very strong positive expected rate of return for their asset class. So if you look across JPM, BNY, Northern Trust, they're all positive and they're all within spitting distance of each other. So no one wants to be extreme in their estimate, and nobody wants to tell you that you're not going to make money in an asset class. On the next slide, we don't just listen to what everybody says. We think, obviously, and go back and forth on if we think if market consensus is reasonable or not. I think we think that cash and fixed income should do better, particularly our fixed income strategy would expect to continue to outperform the broad market. I think it's reasonable to say equities will come in a little bit. And we'll talk a little bit about this in a few slides, but private equity and venture could be challenged here with interest rates where they are. And we still, as you know, love holding gold as a ballast in the portfolio when fixed income is in a strong hedge. So why does all this matter? Well, it mattered a lot to Yale when they built their endowment. And if you might be familiar with David Swensen, who pioneered the Swensen model, and it worked very well in the 2000s for Yale. And the concept is take a lot of illiquidity risk and you'll be compensated for that illiquidity. So what does a classic endowment look like when you take all of these inputs? You get a lot of illiquid equity sensitive assets. This is the Yale endowment on, if you look at the average weights over the last 5 years, you're at about 6% in illiquid equity sensitive investments. And then almost another 20% if you look at hard assets, so natural resources and real estate. This works until it doesn't. And John would probably admit he was a few years early in this kind of analysis. But if you go to the next page, something really interesting is happening. Well, one, we already know this, but this was John's work actually at Cornell when he was evaluating their endowment. There's a high fee hurdle to participate in illiquidity. And we've constantly been asking ourselves, are these fees worth it? If you looked at the last maybe 15 years, maybe in some scenarios they were. But when you need to actually draw on your endowment, the calculus changes. So the basic math is if you want to have a Yale endowment or an Ivy League endowment, about 50% of your draw, give or take, goes to fees first. So it's a pretty staggering number. And what people are kind of waking up to, we think, is the illiquidity is now causing problems. So if you go to the next slide.
And the reason we are saying, actually, and go back, the reason we're bringing this up is not, you might hear like, well, I don't run an endowment, so this doesn't apply to me. But what's occurred is this has also filtered over very much into family offices and even down at the retail level at private wealth, because Blackstone and BlackRock are now, and Apollo are pushing retail illiquid products down. So illiquidity private investment funds has now become a private wealth management in the $1 to $5 million crowd. They need to understand this model, even though Yale and all the other Ivies are big. This is why it's relevant, even to a medium-sized family office or a small-sized family office. Illiquidity has a cost, and it also takes away the ability to get at your money. And as Connor said, it only took me 15 years to be right. But some big Ivy League endowments in the last 5 to 10 days are now panicking and realizing we got to get out our cash, and there's going to be a problem. So skip to the next slide.
Yeah, as John said, the FT actually, this was from the end of March, quoted saying the death of the Yale model. So
with a question mark.
With a question mark, because what's been concerning is lack of exits, right? If you talk to a lot of firms or investment offices that are allocated to illiquid investments, they're worried they can't rebalance into other asset classes because they're not getting distributions and exits. And that's one, because interest rates are higher and we've had a lot of volatility in the stock market over the last few years. Couple that with the next slide, you have an administration now that's threatening to pull funding.
The Financial Times asked a question, you got your answer only 2 weeks later.
So Harvard now is borrowing almost $1 billion in munis because they actually don't have enough liquidity in the endowment potentially to shore up in the scenario that federal funding continues to get pulled. And Yale is trying to sell $6 billion of its PE portfolio in the secondary market. And I don't think it's a stretch to say that the NAV price they're going to get on their underlying investments is not going to be 100 cents. So they're going to have to take a discount to liquidate.
So in March of 2009, this was exact. So this is the last time the asteroid hit. You can have 80% of your portfolio, be it your family portfolio, your business portfolio, or your Ivy League endowment portfolio. You can have 80% of it in a liquid investments that send back cash occasionally and call cash from you. You can have 80% of it in, because if you have 50 billion, you say, well, I'm so rich, it'll never matter unless the asteroid hits. Well, the asteroid hit in March of 2009 when the short-term treasury market froze up and then people couldn't roll their short-term paper. And now another asteroid is hit here in 2025 with this concept of Harvard and the rest under attack, with the potential for maybe losing their tax status. And believe it or not, this was something we actually talked about when we founded the firm like 14 years ago. We said, well, maybe we should think about what people's portfolios would look like if a school lost its tax status. And now it's actually on the table. And even with 50 billion, and none of these endowments have that amount of money, it would be difficult to hold out very long with their current financial model, even with 50 billion, if 80% of your endowment is in illiquid asset.
So ultimately, what's the takeaway? Well, PermCap allocates across asset classes, and we're not saying we hate private investments. You're actually about to hear from Alex Goldfarb, who's going to talk a bit about our success in allocating to private investments. And these shakeups that are happening, where Ivy League endowments are going to be forced potentially to sell chunks of their PE portfolio, actually present a very interesting opportunity for those with liquidity like our clients, because we can take advantage of these discounts in the secondary market, potentially. With that said, I'll turn it over to Alex.
Thanks, Connor. I'm going to talk briefly about some of the flavors of investments outside of stocks and bonds that our clients participate in. The first being gold. So you have heard John talk about gold quite a bit. 13 years ago, we launched our physical precious metals fund for some clients who wanted to take advantage of physical delivery of their gold holdings versus owning it in paper form through an ETF. You can see some of our actual gold here on pallets on the left. We own a mix of 400, 100 ounce, and kilo bars, all stored in a non-bank vault in Dallas, Texas.
This is not in my garage.
We don't necessarily view gold as a one-for-one hedge against inflation, but we like owning it in this environment. Fears of dollar debasement, budget deficits, now a tariff war. And to reiterate one of John's earlier slides, gold was up in 22, it was up in 23. In both of those years, you had outflows from ETFs. So to John's point, if the retail buyer continues to step back in a meaningful way, we think there's still room to run. Another flavor of assets our clients own, hedge funds. 3 of our 9 hedge fund allocations are actually positive year to date through last Friday. So I just wanted to highlight one of our fund relationships that exemplifies the type of funds we look for. This is the 5-year return for a small $500 million fund we've had a long-standing relationship with. Since hedge funds are higher fee vehicles, we want to make sure we're investing with managers who have the ability to generate positive returns, but even do that in down periods for the broader market. You can see here this fund, which owns both stocks and bonds, has managed to outperform the S&P handily over the last 5 years, but even more impressively, managed to do so posting strong positive years in 2022 and this year with the market down. The next slide, there's a lot here on this page, but just wanted to highlight some of the types of companies a firm like this has made money in, most of which I would bet very few on this call have heard of. If we are going to pay higher fees to invest in hedge funds, we don't want them owning commonly held names like Amazon or Microsoft. Next up, co-investments. This is a handful of co-investment opportunities we've participated in, all unique opportunities, public, private, equity, credit, that generally we're able to access at lower fees. In the next few slides, I just wanted to discuss a few case studies for some of the more interesting opportunities we have exposure to at the moment. The first being reinsurance. This is an interesting one that doesn't fall into the stock or bond category. Property and catastrophe reinsurance, I'm sure many of you are aware of skyrocketing insurance costs. Think about reinsurance as the insurance that insurance companies buy to protect themselves against the highest severity events like hurricanes or wildfires. We got a call in late 2022 following Hurricane Ian that there was going to be a serious dislocation in this market. Supply-demand mismatch. We're expecting policy rates to go up anywhere from 25 to 45% on January 1st. We co-invested in the strategy by essentially participating in a pro rata slice of the premiums received and the claims paid out with 5 of the top 10 largest global reinsurers. It's been a fantastic investment for us in the last 2 years. We've returned about 65%. Like I said, no exposure to stocks or bonds. And even through March this year, despite the California wildfires, which were horrific, in many ways, but we're up about 1% to 2% on this opportunity this year. Next up, another interesting one, Endeavor, that we recently participated in. There's been a lot of headlines around this, the appraisal rights and the take private of Endeavor. Appraisal rights are when shareholders don't approve of a merger or an acquisition, they can exercise their right to sue for additional value. And many of you have likely heard of media mogul Ari Emanuel. He's partnered with private equity giant Silver Lake to take the company private in a management buyout. This one was actually brought to us by a close friend in the industry who spent 8 years working for Carl Icahn. He was nominated to the board of Dell, actually, to block a similar transaction when Silver Lake took Dell private back in 2013. This one might take some time to play out, but just highlights another unique opportunity where the outcome won't be impacted by the economy or the stock market. And lastly, just a third flavor of type of co-investment we're exposed to. Monzo is one of our late-stage private investments, sourced through one of our crossover fund relationships. It's a UK digital bank that operates entirely through a mobile application. We invested in Monzo privately in November of 2021. And despite what has been, as Connor mentioned, a difficult 3 years for late-stage growth companies, Monzo was actually able to raise over $600 million last year at a modest increase to our £3.5 billion entry valuation. Today, the company serves over 11 million customers. It's doing more than 700 million pounds in revenue, which is 4.5x where it was when we invested a couple years ago. and actually posted its first full year of profitability in 2024. So we're excited about an exit here either later this year, depending on this environment, or early next year. All of these are co-investments that can be accessed through a fund that we set up, where our clients can opt in and opt out on an individual basis. And then in the event where we do have additional capacity, we are set up where we can offer these ideas to non-clients or outside participants who don't have investment balances with us. So with that, I think I'll turn it back over to Lucy. We've got some Q&A.
Yes, we've had a few questions sent in advance and throughout the session, so we'll start with those, and then please feel free to continue using the Q&A feature to submit additional questions. So first question, it seems like China has major economic problems: floods, real estate collapse, local governments, massive debt, bank failures, significant young adult unemployment, and low incomes, to name just a few. How did China impact the U.S. economy in Q1, and what is the outlook for China and its impact on our economy in the foreseeable future?
So I'll take that. Josh, if we could go back to slide 14. So, we're at a really interesting stage where you've got China effectively shut out of the U.S. market right now. So, the question is who blinks first. It takes a long time for the U.S. to kind of rejigger its supply lines. So that means that if you were, say, a U.S. CEO and you were thinking about switching your supply to somewhere for whatever, for some widget that you need, to Latin America, and signing a long-term contract for more expensive widgets to come out of Latin America and get rid of your Chinese supplier, you've got uncertainty. So, so everything stops. So we're not going to sign the new contract. We're now moving our supply lines because Trump could just declare victory next week and say, okay, we'll settle at 40% tariffs up from 25, and we're going to continue to watch you and, threaten you. So that creates instability. So I think chances of a recession are higher just because it's a logical thing for a CEO to do is, hey, like, we need to spend less money. We need to kind of buckle our chin straps. It increases chance of recession. That's what oil is telling you. The second thing with China being, an unstable economy, they have a couple problems. They have a rolling real estate crisis, which has resulted in regional bank failures, which also their biggest consumer just went on strike. So you literally have ships mid-ocean that kind of get turned around. And so I think it's a bigger impact on them than on us. It certainly creates agita over here, but it's a much bigger untangling. So I think the key question is, do you believe we're in a negotiation with China, or do you believe we're in a war with China? And I think the way the Chinese define war is a continuum, starting with economic competition, not friendly. We're talking about the elbow throwing sort of competition, all the way up to kinetic war. So do you believe we're in a continuum of war with them, or do you believe, and that the U.S. has woken up to this, or do you believe this is just going to be a negotiation that just kind of gets settled? I believe it is a continuum of difficulties, as opposed to just a quick negotiation with a higher tariff level. So I'd expect it to go on with China for a bit. And the longer it goes on, the more we can unite other people to our side on it.
Thanks, John. Next question. You guys talk about gold every webinar, and now I understand why. Do you think gold is going to continue to do so well?
Connor, Alex, you guys want to take that?
Yeah.
Kind of touched on it, but just given the uncertainty you're seeing with respect, especially to the deficit, I mean, I think you've had a big central bank buyer for a handful of years now without retail participation. And, if people are scared about what their fixed income mutual fund performance is going to be, or is there stress in the levered loan market, and maybe does the dollar lose its reserve currency status? There's not a lot of other options out there. You've seen Bitcoin rally back, but from what we've seen historically, Bitcoin is more pro-cyclical and it tends to be correlated to other risk assets, especially the Nasdaq. Would we consider layering some of those other assets in for our clients alongside gold? Sure. But you're still just starting to see retail flows come back into gold. So we might not stay up at 10 or 20% for certain clients. And John mentioned we're going to use it as a funding source on any material pullbacks beyond just kind of a 10% correction in the equity market. But we still think there's some room to run for sure.
Alex, this is another question for you. Can you walk us through how you source co-investments and where they come from?
Yeah, the vast majority are sourced either through managers we invest with or the broader network of investors, founders, sponsors that we've built over the course of the history of the firm. I mean, I've been here for a short 11 years, but John and Joe Steinberg have been at this for 30 and 50 years, building incredible networks. I think we've done a good job of positioning ourselves as, a value-added partner who can generally move pretty quickly on these things. We're highly selective. I think last year alone, we did work on over 60 opportunities in earnest, passed on many more upon an initial look. So I think going forward, we probably expect to do between 2 and 4 a year. I mentioned earlier, it's not just private equity or venture opportunities. It's public, it's private, it's equity, it's credit. It's things that don't fit into any of those buckets like reinsurance. So, we have a pretty wide and active pipeline, and it's been a really unique, differentiated source of return for our clients.
All right. Next question. Do you think the recent weakness in AI-related Mag 7 stocks reflects signs of a bubble or similar to the dot-com era, or are these companies still strong long-term investments?
Yeah, I mean, no different than any other transformational era in America. And the last one we saw was the internet. You have a lot of froth around companies, and no one really knows who's going to win the AI race or if there is going to be one winner. We are seeing a lot of companies invest an incredible amount of money in developing their language learning models and infrastructure, CapEx. What's probably reasonable is to think that ultimately there'll be companies that spend an incredible amount of money only to realize that maybe we figure out a way to make AI very energy efficient and useful. I think there's companies like Palantir out there that are figuring out how to become like the next consultant model for AI. Those companies probably figured out that business isn't going away. But ultimately, AI is going to increase productivity to levels we probably can't even comprehend yet. So maybe in the near term, we've seen some pullback in valuations, justifiably with the risk that's out there. But AI isn't going away, and it's only going to continue to grow. The question is it accessible through public or private markets? What's a better way to do it? But long term, AI is going to continue to improve dramatically.
Okay, and then this is our last question. How do you see the tariff situation playing out over the next year?
I'll take that. Actually, Josh, put a conclusion slide up. Thank you. So the conclusion will come with the Mar-a-Lago Accord. I think that nomenclature appeals to Trump's sense of wanting to put his stamp on things. I think it is a global reordering. The question is, how far does it really get to? So, I think that the tariff, you kind of look at it like, okay, what makes the market go up? What makes the market go down? Slow tariffs, 90-day moratoriums, 90-day holds, uniting people against China, that makes the market go up. Immediate effect of tariffs go into effect in the next 24 hours, doubling, tripling of tariffs, increasing escalation, the public verbal escalation with trading partners or trading competitors, that makes the market go down. So let's do more of the things that make the market go up and less of the things that make the market go down. I think that we are headed towards a global reordering here. The question is, like, at what point do we declare victory? And I think that if we go back to the way the tariff card looked, rather than negotiating with us against the world, let's take 15 people in a room and have 15 difficult negotiations where we really get tough with people, because we should care about the dollars and less about the grandstanding. And I think the tariff card was kind of like the tariff poster was like an ill thought out strategy of how to unite everybody against us. So it seems like they've backed off from that. They're going to have these get our friends together, because everybody needs to understand that China is a problem for everybody. If they're eating our lunch, they're coming to eat Myanmar's lunch too, and more easily. So that is, I think, once we convince our trading partners and friends that that's the conclusion, then you're going to get some tariff sanity. But it's clearly going to slow things down. The other thing that's been said repeatedly is think of tariffs as a consumption tax. And if you don't think that certain people in government want to change U.S. consumer behavior, like maybe you don't need 6 flat screens in your house, and if you do, it's going to cost $3,000 a screen instead of $500 a screen. So that's a consumption tax. And if you can afford 6 flat screens, God bless, but it's going to include tariff that will cause consumer behavior to change. So I think as much as they want to change trading partner behavior, that this is geared towards being a consumer behavior change in the U.S. And which is kind of like Switzerland. Switzerland stuff is very expensive, and you buy a little of it, but there's a focus on buying the finer things, higher prices, but less of them. So I think we need to be a little more like Switzerland and a little less like we've been. And I think that's kind of where they're going to try to go with the tariff conclusions. Any other questions, Lucy?
No, that was our last question. Thank you.
Okay, I want to thank everybody, and thank you also to the 290 people who attended the Bill Ackman talking last week at the Citadel with us, and thank you to our attendees at Vine. If you have any questions or if the markets are giving you agita, please drop us a line or an email, and we look forward to speaking with you next quarter.